What's going on, y'all? It's your girl Jazz back with some tax saving tips, business owner money saving tips, because that's what I do and that's what I bring. So, I want to talk about us leaving money on the table. Yes, when we are using the home office deduction, most of the times the tax preparer is leaving money on the table. If you're a tax preparer, you may be leaving money on the table for your clients because there's a very big difference in the simplified versus the actual method for the home office deduction. So, the home office deduction is a way for people that work from home to lower their taxes. You can deduct a certain portion of your expenses, like your rent or your mortgage. You don't have to own the home. It works if you rent as well. Your mortgage interest, your utility bills, your homeowner's insurance or your renter's insurance, your property taxes, HOA fees, the list goes on and on. Everything you need to run and function your home. Um, this deduction in the past, though, was something that was kind of shied away from because before the big .com era, there were not a lot of people who worked from home. Even when you owned your own business, you still had a separate office, and then you came home, and your home was your home. Um, you might have had a home office. Most of the time, people just kind of shied away from taking that deduction because it was a kind of a red flag for the IRS because it was just something they weren't just used to. They felt like, somebody was trying to get some extra money that they weren't owed. Well, now times have totally changed, and since COVID, IRS doesn't look twice at the home office deduction. But there are some specific rules that you need to follow when you are taking this deduction. First one is that this must be your primary residence. You cannot take this deduction if from a rental property that you may have or something like that. It has to be your home. Second, it has to be exclusive use. That means it can't be a room that's dual purpose. Bedrooms, definitely a no-no. Dining room, you can't say I have my computer on my dining room table and that's where I work. That doesn't qualify. Now, if you do want to use, say your dining room is very large or even your living room, you can section off a space. Now, I'm not talking about building a wall. I'm talking about using a bookshelf or your um, cabinet, for your file cabinets, things like that, to make this a dedicated space. This side, this line here is where my office starts. That is acceptable. And then third, always keep good documentation because that's what you're supposed to do as a business owner anyway. So, the number one tax preparer mistake is that most of the time the IRS always offers a simplified option for you to deduct just a set rate per square footage of your home space instead of actually calculating the full expense. Rule number one, if the IRS is giving you a easy way to do something, it's a trap. They know that if you don't do the work, they're going to give you a little bit of money and they're going to keep a lot more money. Don't do the simplified method. So, let's say you have let's say your apartment or your office or your home is 1,500 square feet. And you have a 300 square foot office. It's your spare bedroom, a place in the basement, something like that. 300 square feet. Make your numbers real simple. You do the math, that's 20%. So 20% of your home or your apartment is what is tax deductible. But if your rent is $1,500, then if you take that $5 that the IRS gives you with the simplified method, multiply it by your 300 square foot office, you're going to get a $1,500 deduction. And that's that. Simple, easy peasy, mac and cheesy. Everybody goes about their business. You put in those two numbers, bada boom, bada bing, you get $1,500 deduction. Now, we're going to get into the real stuff. If you do the actual method, and gotta move my little head around, and same criteria. You have your mortgage or your rent is $1,500 per month. Your home office is 300 square feet. That's 20% of your home. Now you can actually calculate all the expenses it takes to run your home and take 20% of that per month. I'm going to say that one more time for the people in the back. Per month, you get to take the deduction and add that up. So if you have the $1,500 rent, 20% of that is going to be $300. That means $300 a month for 12 months. Your homeowner's insurance, say it's $200. You pay $300 in utilities. Your homeowners association fees are $250 a month. You have repairs for the year that was, let's say it totaled up to be $2,500. You total up all that stuff for the year, and it comes out to be $26,500. You take 20% of all of those items, you get a deduction of $5,300. That's a big difference, and that's how we leaving money on the table. $1,500 using the simplified method, $5,300 using the actual method. So which one you gonna start using, huh? So we are going to stop leaving this money on the table for the IRS to keep. They don't care that they know you can get more with the other deduction. They don't care. That's why they put that simplified method out there for you. So stop leaving money on the table. Keep your good records. Section off your office space. Make sure it's dedicated. IAmJasmin, empowering entrepreneurs worldwide. Don't forget to stay connected with me. Follow me on all my social media. Of course, you're on my YouTube channel. Like, share, subscribe. You know, all the stuff that you do on YouTube.